Welcome to another audit walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over Audit Area 4. This is our first video for Audit Area 4. This is Section A. This is a remembering and understanding topic. Identify the factors that an auditor should consider when forming an opinion on an entity's financial statements. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. Again, it's free, it is only 1 hour long, and we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years failing the exam. So make sure you check that out, and after you watch that, you're going to want to learn more, so make sure you also check out becoming a SuperfastCPA Pro member. In today's video, we're only going to be going over 5 questions, and typically, SuperfastCPA Pro members get access to the full 10-question version of the video. Now, to be honest, in today's video, we're only going over 5 questions for YouTube and for the members because this is a pretty small topic, but it's a good primer for what we're about to talk about in the next video when we start talking about audit opinions. So again, we're only going over 5 questions for members and for YouTube, but typically Pro members of SuperfastCPA get access to the full 10-question versions of the videos, so they get a little bit more help and a little bit more practice. So if you like this and you like our other videos, make sure you check out becoming a SuperfastCPA Pro member. Now with all that, let's dive straight into the questions. All right, here we are at question 1. Let's just dive straight in. Which of the following best represents a factor an auditor must consider when determining whether the financial statements are prepared in accordance with the applicable financial reporting framework? Okay, so let's walk through this. Option A, whether management intends to release the financial statements to external users. Option B, whether the financial statements consistently apply appropriate accounting policies and include required disclosures. Option C, whether the auditor identified any significant internal control deficiencies during the audit. Or option D, whether the audit team experienced delays in receiving requested documentation from management. So, again, which of these is something they're going to consider when they're determining if the financial statements are prepared in accordance with the applicable financial reporting framework? Now, if you don't know, that's okay. We are going to look at the explanation to start learning about this. Okay, here we are. The answer is B, whether the financial statements consistently apply appropriate accounting policies and include required disclosures. Here's the explanation. A key factor an auditor must consider when forming an opinion is whether the financial statements comply with the applicable financial reporting framework. This includes evaluating whether appropriate accounting policies have been selected, whether they are applied consistently, and whether the disclosures meet the framework's requirements. This assessment is part of forming a professional judgment about the fairness and reliability of the financial statements. The other options reflect considerations that may affect the audit process, but do not directly address whether the financial statements are in accordance with the reporting framework. So this is something that auditors need to be considering. This is a factor that they need to be looking at when they are starting to try to form an opinion for an audit. Again, they are trying to make sure that the statements comply with the applicable financial reporting framework, and they might do that by making sure they have the correct accounting policies, that they're applied consistently, and that the disclosures meet the framework requirements. So that was one thing that the auditors need to consider when they're forming an opinion. Now let's go to the next question. All right, here we are at question 2. When forming an opinion on the financial statements, which of the following best represents what the auditor must consider regarding audit evidence? Let's go through the options. Option A, whether the evidence obtained is sufficient and appropriate to support the conclusions in the audit report. Option B, whether the audit procedures were performed by staff with relevant industry experience. Option C, whether management reviewed the financial statements before issuing them. Or option D, whether the client's accounting system was implemented within the last year. So if I'm honest, just based on your experience with audit, you probably already know the correct answer. But if not, that's okay. We're going to look at the explanation in just a second here. If you want, pause the video to think about this. If not, again, let's go ahead and take a look at the explanation. All right, here we are. The answer is A, whether the evidence obtained is sufficient and appropriate to support the conclusions in the audit report. And again, if you've watched any of the other videos or if you have any experience with audit, that one probably stuck out to you. Let's go through the explanation. Before forming an opinion, the auditor must evaluate whether they have obtained sufficient appropriate audit evidence to provide a reasonable basis for that opinion. Sufficiency refers to the quantity of evidence, and appropriateness refers to the quality, its relevance and reliability. This is fundamental to the audit process and directly impacts whether the auditor can conclude that the financial statements are free of material misstatement. The other options may relate to audit planning or context, but are not the key consideration at this stage. So again, this is another factor that they are going to have to consider, whether the evidence that they gain is sufficient and appropriate. That's again a factor that they're going to consider when they are trying to form their opinion. Now let's go to the next question. Okay, here we are at question 3. When forming an opinion on the financial statements, an auditor must evaluate the effect of uncorrected misstatements identified during the audit. Which of the following best describes the auditor's responsibility regarding these misstatements? Let's go through the options. Option A, request that management disclose every misstatement regardless of size in the notes to the financial statements. Option B, reclassify any immaterial misstatements as audit differences that need no further action. Option C, aggregate the uncorrected misstatements and determine whether they are material, individually or in the aggregate, to the financial statements as a whole. Or option D, disclose the total dollar amount of all detected misstatements in the auditor's report, even if they are immaterial. So again, what are they going to do when it comes to uncorrected misstatements? What's the auditor's responsibility when they have to deal with these and when they're forming their own opinion? If you have any idea, or if you want to kind of think about this, pause the video and do that. And when you're ready, come back, we'll look at the answer together. All right, here we are. The answer is C, aggregate the uncorrected misstatements and determine whether they are material individually or in the aggregate to the financial statements as a whole. So let's go through the explanation. Before expressing an opinion, the auditor must assess whether the remaining uncorrected misstatements, both individually and in total, could reasonably influence the economic decisions of users. If the aggregate effect is material, the auditor must require adjustment or modify the opinion. Options A, B, and D either overstate or misstate the auditor's obligation. Not every misstatement must be disclosed. Immaterial items cannot simply be ignored without aggregation, and immaterial totals are not reported in the auditor's opinion. And again, this is something that they need to consider when they are forming their opinion, because if there are uncorrected misstatements, that's going to affect the opinion that they give for the audit. And we're going to talk more about the actual opinions finally in the next few videos. But that was one more thing they have to consider. Now let's go to the next question. All right, here we are at question 4. As part of forming an opinion, an auditor reviews the financial statements to assess whether the terminology used is appropriate. Which of the following would most likely raise concern during this review? So let's go through the options. Option A, the financial statements refer to net revenue and gross margin without further explanation, even though these terms are common in the industry. Option B, the statement of financial position refers to reserves instead of retained earnings, even though US GAAP terminology is required. Option C, the notes to the financial statements describe the company's revenue recognition policy in detail. Or option D, the financial statements include a breakdown of expenses by function and nature. Now, if I'm honest, this one might be a little bit confusing, and you might be thinking, really, do any of these really matter? But this is something that an auditor does need to consider when they're forming an opinion. So if you have any idea, or if you want to think about this, then pause the video. If not, let's go ahead and take a look at the explanation together. All right, here we are at the answer B. The statement of financial position refers to reserves instead of retained earnings, even though US GAAP terminology is required. So let's talk about that a little bit more and talk about why that's actually important. When forming an opinion, the auditor must consider whether the terminology used in the financial statements is appropriate for the applicable financial reporting framework. For example, using terms like reserves instead of retained earnings may be misleading or inconsistent with US GAAP terminology. This could result in the financial statements being unclear or not in conformity with the reporting framework. The other options reflect either appropriate terminology or adequate disclosures. So this might seem like something that really doesn't matter, but this is something that the auditor needs to consider when they're forming an opinion, because, if they are using the wrong terminology, that could technically be misleading. And so the auditor might have to give a modified opinion of some kind if management doesn't fix it. Now, that might seem silly, but again, that is something that matters. So this is something that auditors need to consider. Now let's go to the next question. Okay, here we are at question 5. An auditor is engaged to audit the year 9 financial statements of Harvest Co., which also presents comparative financial statements for year 8. Management has asked the auditor to express an opinion on both periods. Which of the following must the auditor consider before issuing an opinion on both years? So let's go through the options. Option A, whether management plans to release the financial statements to external lenders. Option B, whether the year 8 audit documentation is available for review by those charged with governance. Option C, whether the financial statements include pro forma disclosures for anticipated year 10 results. Or option D, whether sufficient appropriate audit evidence has been obtained for both year 8 and year 9. So when there are these comparative financial statements and the auditor is supposed to give an opinion on multiple periods, what is something that they need to be considering when they are forming their opinion for those years or for those periods? So think about this, pause the video if you want to, and when you're ready, come back, we'll look at the answer together. All right, here we are at the answer D, whether sufficient appropriate audit evidence has been obtained for both year 8 and year 9. Let's go through the explanation. When an auditor is asked to express an opinion on comparative financial statements, they must elevate each period individually and ensure that sufficient appropriate audit evidence has been obtained for each period presented. This includes reassessing prior period evidence or reperforming procedures if necessary. The other options are unrelated to the auditor's responsibility when providing opinions on multiple periods. Now, we learned a lot of small things throughout this video. Again, a lot of small factors that auditors need to consider when they are trying to form an opinion on the audit. Now, with that, before we do anything else, let's do one more part of the SuperfastCPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 2 or 3 or maybe even 4 questions trying to teach you about the responsibilities that auditors have for different kinds of factors when they're trying to form an opinion. You're learning the different kinds of factors that they need to form an opinion on. And again, these are the kinds of things that keep popping up in the questions. So you take a moment, you write these out in your own words as, again, the most important things you learned. And as you do this each day, you are building your own personal repository of the most important things you learned from the questions in your own words so that you are ready for the exam. So let's go ahead and take a look at the pillar topics for this video. All right, here we are at the pillar topics. Let's just dive straight in. First off, compliance with the reporting framework. And again, remember, these are all factors that auditors have to consider when they're forming their opinion. So again, compliance with the reporting framework, the auditor assesses whether accounting policies are appropriate, applied consistently, and accompanied by adequate disclosures. Now let's talk about sufficiency and appropriateness of evidence. A reasonable basis for the opinion requires enough relevant, reliable evidence to support audit conclusions. That makes sense. They have to have enough evidence to actually have a good opinion or to even have an opinion. Now let's talk about evaluation of uncorrected misstatements. Any misstatements left uncorrected must be aggregated and judged for overall materiality. Material misstatements require adjustment or a modified opinion. Now let's talk about appropriateness of financial statement terminology. Terms used must align with the applicable framework. Misleading or non-standard wording indicates nonconformity. Again, that might seem small, but that actually is something that the auditor needs to pay attention to and could be a big deal. And then finally, evidence for all periods in comparative statements. That was the last thing we talked about. When opining or when giving an opinion, you might actually see that word, so I wanted to throw that in there. Opining is the word for, giving an opinion. When giving an opinion on multiple years, the auditor needs sufficient appropriate evidence for each period presented. So if the auditor is going to give an opinion on multiple periods, they have to make sure that there's enough sufficient appropriate evidence. And honestly, they really have to kind of do most of these things for both periods if they're trying to give an opinion on multiple periods. So with that, that is the end of this video. Remember, in today's video, we only went over 5 questions, and that is going to be the case for the pro members as well. But typically, pro members get access to the full 10-question versions of these videos when we post them in the member forum so that they can get a little bit more practice and a little bit more understanding. We just did 5 today because it's a pretty small topic, a pretty straightforward topic, but I wanted to go over it before we start diving into the actual opinions because I feel like this is a decent basis to have before we do that. But again, normally members get access to the full 10-question versions of the videos. So if you like this and you like our other videos, make sure you check out becoming a pro member. And the easiest way to do that is by actually going to SuperfastCPA.com and signing up for our free 1-hour webinar training. After you watch that 1-hour webinar training, you're going to have learned a lot. You're going to know a lot more about SuperfastCPA, and that will give you a good path to learning about and becoming a SuperfastCPA Pro member. So go do the webinar first and then check out becoming a SuperfastCPA Pro member. Now, I hope this video was helpful. If you liked it, make sure to like it and leave a comment, and I will see you in the next video.